Hey there. If you're Canadian, you know that taxes can be a real pain. Every year, you see the government take a chunk of your hard-earned salary and you wonder if there's anything you can do to ease that burden. Well, the answer is yes. In this video, I'm going to show you how, in 2025, you can legally reduce your taxes, keep more of your money, and invest in your future. It's not magic, it's smart tax strategy that's simple and effective. Don't worry, I'll make everything super easy to understand. So if you want to learn how to save thousands of dollars on taxes, whether you're salaried, self-employed, or even running a small business, this video is for you. Get ready to change the way you look at taxes. Before diving into the tips for reducing your taxes, it's important to understand how the Canadian tax system works. Because to play this game, you first need to know the rules. Canada has a progressive tax system, meaning the more you earn, the higher your tax rate. This applies both federally and provincially. Canadian provinces have their own tax rates, which means your taxes can vary depending on where you live. In 2025, the federal tax rate starts at 15% for the first $50,000 of income and increases as you move up the income brackets. For example, if you make $100,000, you will be taxed at a higher rate on the portion of your income above $50,000. This is called the marginal tax rate. On top of that, each province imposes its own taxes, meaning if you live in Quebec, for example, the combined tax rate is higher than in other provinces like Ontario. But here's the good news. The system also offers tax deductions and tax credits that can lower the amount you actually pay. And that's where things get interesting. One of the best ways to immediately reduce your taxes is by using an RRSP, Registered Retirement Savings Plan. Many Canadians know about this tool, but not everyone fully understands just how powerful it can be for saving on taxes. An RRSP is a savings account designed specifically for your retirement, but that's not all. By contributing to an RRSP, you lower your taxable income for the current year. In other words, you pay less tax right away, and your money grows tax deferred until you withdraw it, likely in retirement, when your tax rate will be lower. Let's say you earn $70,000 a year and contribute $10,000 to your RRSP. Thanks to this contribution, your taxable income drops to $60,000, which means you pay less tax. For a Canadian living in Quebec, this could mean saving $2,500 in taxes. This is especially beneficial for those with higher incomes, as the tax reduction becomes exponential. Why should everyone use an RRSP? An RRSP is a perfect solution for anyone who wants to pay less tax right now. If you want to reduce your taxes, this is one of the best options. But be careful. There's an annual contribution limit. In 2025, this limit is $29,210. Of course, you don't need to contribute that much, but the more you contribute, the more you save on taxes. Let's move on to another super powerful tool, the TFSA, Tax-Free Savings Account. The TFSA is kind of the opposite of the RRSP because it works differently, but it's just as effective for saving taxes. How does the TFSA work? Unlike the RRSP, contributions to the TFSA are not tax deductible, but any money you invest in a TFSA grows tax-free. This means that interest, dividends, and capital gains generated within your TFSA will never be taxed, even when you withdraw the money. It's like a tax-free zone for your investments. Let's say you invest $5,000 in your TFSA. After 1 year, your investments generate $500 in gains, and you won't have to pay any taxes on that $500. This allows you to keep 100% of your gains. So yes, the TFSA is perfect for growing money over the long term without worrying about taxes. Why use a TFSA? If you want to invest for the long term, a TFSA is an excellent choice. It's also a great tool for those who are young and want to build wealth without having to worry about taxes. Now, let's talk about self-employed workers and small business owners who have a major tax advantage over salaried workers. You can deduct a lot of business expenses before calculating your taxes. Deductible expenses, home office expenses, the cost of equipment, travel expenses, and even a portion of your phone and internet bills can be deducted. Essentially, if you use these resources for your work, you can subtract them from your income before calculating your taxes. Real example, let's say you're a graphic designer and you work from home. You have a dedicated workspace and your home office expenses total $3,000 per year. If you deduct this amount from your income, it reduces your taxable income and therefore your taxes. In this case, if you're in a 30% tax bracket, you could save up to $900 in taxes. Not bad, right? How to maximize your deductions. The key here is documentation. Keep all the receipts and invoices for your expenses because the Canada Revenue Agency, CRA, may want to verify them. In addition to tax deductions, there are tax credits that can directly reduce what you owe. For instance, you can get credits for medical expenses, childcare expenses, or even for post-secondary education. Let's say you spent $2,000 on medical expenses this year. If you can prove that these expenses exceed a certain percentage of your income, you can claim a tax credit for medical expenses. Depending on your tax situation, this could reduce your tax bill by $500 to $1,000, or even more. Credits for education and childcare. If you have children, you can also claim credits for childcare expenses. And if you're pursuing education or have learning-related expenses, you can also benefit from credits for those costs. In 2025, there are a few changes that could impact your taxes. For example, the RRSP contribution limit has been increased this year. This means you can now contribute more to your RRSP, further reducing your taxable income and saving even more on taxes. Additionally, the government has introduced new tax initiatives for families and small businesses, including increased tax credits for childcare and support for self-employed workers. These initiatives help Canadians better manage their finances while boosting economic growth. There's one thing you should take away from this video. Tax planning is everything. Don't let taxes surprise you every year. By using tools like the RRSP, TFSA, tax credits, and deductions for self-employed workers, you can legitimately reduce your taxes and keep more money for your future plans. Start incorporating these strategies into your financial life today, because every dollar saved today is a dollar that can work for you tomorrow. Don't forget to subscribe for more practical tips and strategies for managing your finances. If you enjoyed this video, leave a comment or share it with friends who also need to know how to save on their taxes. See you soon.